Hello traders, what's going on? In the previous lecture, I have discussed about the basic formation and characteristics of Fibonacci extension level and how to apply behind the chart. It also used to calculate how far the price may travel to finish. In this section and the next two lectures, you will learn about the risk management on a price action chart. From this lecture 1, you will learn about the risk management in the financial market. So in this lecture today, I am going to tell you about the identify the risk. So risk management procedure is an essential part of an investment strategy. So let's start. Risk management. Risk management is the process to identify the potential market risk in your investment portfolio and taking a step to mitigate the risk. It can also help protect your account from losing money. After all, you can generate substantial profit to maintain with proper risk management strategy. You should work out the attitude to market risk, thinking about risk and reward ratio, position size, and percentage of accounts balance of each trade. You also place stop loss to protect against the market going against your position. There are few risks that are facing in the liquid market trading, so some risks are given below. Currency risk. Currency risk is the risk that associates the fluctuation of currency price, making it more or less expensive to buy foreign assets. Currency risk is the possibility of losing money due to unfavorable moves in exchange rates. Currency risk or foreign exchange risk refers to the potential loss that an organization may incur as a result of fluctuation in currency exchange rates. Currency exchange risk is an important factor to consider for any international business, no matter how big or small the size of your company, so that currency risk is the most affected for you. You can set the rule of mitigate the risk. Interest rate. Interest risk is related to the sudden increase or decrease of interest rates, which affected volatility. Interest rate changes affected market price because the level of spending and investment across an economy will increase or decrease, depending on the direction of the rate change. An economy's interest rate can have an impact on the value of the economy's currency, which means you can be at risk of unexpected interest rate change. Liquidity risk. Liquidity risk that you cannot buy and sell an asset quickly enough to prevent a loss. Even though Forex is highly liquid market, there can be periods of illiquidity depending on the currency and government policies around foreign exchange. Leverage risk. Most financial traders use leverage to open trades that are much larger than the size of their deposit. In some cases, it's even possible to lose more money than you initially deposited. So while leverage can increase the potential profit, it also has the capability to increase potential loss as well. That's why you should choose carefully the amount of leverage on your trading accounts. So not more today. Have a nice day. Goodbye.